Hi, I'm David Cataford, CEO at Champion Iron. We operate an iron ore mine in the north of Quebec, produce one of the highest grade materials in the world, and are currently transitioning to be able to produce direct reduction iron, so the solution to decarbonize the steel industry. And we want to be a key actor in this field. Already produce around 15 million tons of this high grade material per year, and we've got a lot of potential to be able to feed the market in the next coming years.
Good to see you again, sir. I saw you back in September. We went on a bit of a run there, and today we're going to talk a little bit about what happened in Q3. We're going to talk about the kind of setup for 2025 looking good, but I think we better start a bit broader than that with some of the more recent news headlines, which is around tariff disputes, geopolitical risk, and logistical disruption around the world. So give us that setup. What's happening out there?
Yeah, there's been quite a lot of noise in Canada, you can imagine, with the tariffs and with the discussions between U.S. and Canada. Very fortunate that we do not sell any tons into the U.S. So our main markets are Europe, the Middle East, China, Japan, India, Korea. So we typically sell areas that are far away from the U.S. and pretty happy about that strategy today.
I bet. But will it have a sort of knock-on effect? I mean, in terms of, will there be clearly tariff wars, and not necessarily it was a good thing, great bargaining tool, but not necessarily a good thing. Will it have a knock-on effects in terms of pricing, in terms of bifurcation of markets, in terms of the direction in which your iron ore concentrate flows?
Yeah, we'll definitely follow that over the next little while. The big advantage for us is this is a transformational year. We're heading into a new product, and we're really focused on selling this new product into the world. And when we look at our various clients, they're typically in Europe, Northern Africa, Middle East, which are booming. Well, maybe Europe a little less, but North Africa and the Middle East are booming markets right now in terms of steel production. So ripple effects on tariffs, on prices, we'll monitor that. But again, because we're on a different sort of trajectory, and we definitely want to use this year to materialize our projects, to deliver them on time, on budget, as we've done before, and go more into those new markets.
Okay, and obviously, you'll have one eye on the market, and and I'm sure it'll change week by week. But you must have a sort of sense of things that you want to particularly keep an eye on to help you work out how you position yourself competitively. But also in terms of maybe opening new markets up.
Yeah, when we look at the world today, there seems to be less talk about decarbonization and a lot of focus on tariffs, a lot of focus on geopolitical events. Realistically, what we're seeing in terms of decarbonizing the steel industry, it's still moving forward. I'm sure we'll discuss a little bit later the investment that the Japanese have made in one of our projects. We're seeing quite a lot of development into the Middle East, all looking to go towards green steel or greener steel, benefit from their use of natural gas to be able to produce one of the lowest CO2 intensity steels in the world. So a lot of different elements that we're monitoring. The one that we're really focused on is to make sure that is there still growth in this DR grade market. And what's interesting, when you look at the graphs, steel has not been in a growing market over the past few years, but the one that is increasing and still forecasted to increase is that use of extra pure high grade material, because DRI plants, the potential clients for this type of material, they're being built all around the world. So they've been sanctioned a few years ago. They were financed, they're being built, and they're now coming online. So that is not changing. So we're really monitoring that very closely because that's our future market.
Right, okay. And with regards to the supply chain, I'm thinking specifically things around like freight costs, energy, etc. Are there any sort of, again, things that may affect the industry as a whole there, which you're going to have to react to?
Yeah, well, a lot of people focus on the price of iron ore, but as we've chatted in the past, you really have to look at iron ore and shipping in tandem. And when you look at the C3 index, which gives us a good idea of what our shipping cost is, that's the shipping between Brazil and China. It's a fixed index. And this index today is close to all-time lows. So we're at roughly 17 to 18 US dollars per ton. Just to give a view on where we've seen that market, it's hovered between about 15, 16 bucks per ton to all the way to $40 per ton. So when you look at today, we're very well positioned. Iron ore price is holding up for our material around 115, 120. So the pricing environment has been fairly good, even in this current context.
We'll kind of touch upon some of these kind of global issues in a second, but in the context of what Champion Iron is doing, what it can take advantage of. So we'll sort of come back to some of those points in a second. Look at your share chart from 2020, 2021. Good, strong growth. You've been kind of moving this project through the phases and being rewarded. Now this quarter, and mining does this to you, it wakes up and sometimes chooses violence. Q3 didn't quite kind of hit the mark, didn't follow the pattern. So what happened?
Yeah, well, realistically, we can go even back a few months. Q2 and Q3 were difficult quarters. So Q2, we were hit by the forest fires that we chatted last September when we spoke. Then Q3 was going better. And in December, we had an equipment failure on our loadout, so where we load our trains. First time this has happened, an equipment that has been operating flawlessly since 2010. And it took quite a lot of time to be able to get in there and get our people safely. So if you can just imagine, it's the area where there's a silo that is just on top of the rail cars when they come in. So the chute that opens and closes when the material comes in, this is what broke. And to be able to go there safely took quite a lot of time. Since now, in December, we've modified the way that we can access it. We've modified all the plans. We've got new spare parts. So if ever it happens again, we would be able to fix it a lot quicker. But it took about 2 weeks to be able to fix that. Hence our lower sales during the quarter, and also affected our production. So I think we've been speaking together for a few years, Matt, and since 2018, we've been operating flawlessly in terms of the quality of the equipment. This is the first time that we've got an event of that sort of magnitude. But again, I think we've solved it in a way now that if ever it would happen again, well, we're protected to be able to solve this quickly.
Well, obviously, like the loadout equipment, it's a seemingly simple piece of kit, but as you say, to fix it safely, it takes time. This had a big effect for you on revenues, net income, production, C1 cost, cash costs, etc. I suspect off the back of this, looking across all of the equipment and trying to work out, how do we stop ourselves being put in a position like this again? So what are the things that you're looking at in terms of mitigating a risk like this?
Well, realistically, when you look at even just the investor that the insurance company that we work with, it's a company that has quite a lot of engineering capability inside house, and we do a yearly review with all their engineers on all the different points. We've got our own risk assessment internally, and we've always done this fairly well. Small little differences in our shutdowns, but realistically, I think the market has not seen that because we've seen our production increase quarter on quarter for the past years. Pretty steadily. Now we had two issues. The forest fires, we've done quite a lot of mitigation last year when they came close to the site, again this year. So small interruption in production due to the fact that we had to get people out just to make sure everybody's safe, but had a minimal impact in terms of the scope of our actual equipment. And when you look at the last quarter, definitely this event allowed us to do a more deep dive into the whole loadout facility, which we've seen no other red flags. Also do it on the site, but it's something that we continuously do.
We'll come on to things like product optimization and obviously driving volume and sales and associates in terms of market expansion, etc. But just sticking on the rest of things, because I think people need to kind of feel comfortable that they understand what's being done, what exactly it takes. So in terms of the loadout equipment, when you say you kind of reviewed everything and made some changes, what does that actually equate to? And does that change the kind of cost structure for the business?
Yeah, it doesn't change the cost structure apart from last quarter because we had to invest on maintenance to be able to fix it. But when you look realistically what happened, it's a fairly simple equipment. So we've got a rail loop that has the rail cars that come in, and then we have on top of that a chute, and there's a conveyor that comes towards a small silo on top. So a small conveyor comes in, puts material in a small silo, and then it opens and it closes a gate as the rail cars come in. So fairly simple equipment. It's just that it broke on the silo portion, and it didn't fall off. So because it didn't fall off, we had to make sure that we secured that before we could get people in to be able to come in and fix the equipment. So now the modifications that we've done is that if ever this would break at the same place, one, we've got a procedure to be able to get people in, and we've got places that people can come in and safeguards to make sure that they can go in safely and do the repair. So it wasn't that complicated of an element, but because it was a first for us, well, we wanted to make sure to get everybody out of there safely.
Right. Okay. And in terms of, again, just sticking with learnings and application to driving that kind of growth component of your story. Say next 2 years, the setup for the next 2 years looks quite good. If I look at things like what's going on at Bloom Lake, you're obviously looking to kind of ramp things up there. Cami's obviously moving through the phases, etc. What are you sort of targeting your teams on? What are the specific deliverables of 2025, for instance, or 2026 that you think we've got to be on this in terms of this risk mitigation element to ensure we can deliver against the guidance that we're leading the market with?
Yeah, well, if you look at since we've delivered our expansion, the phase 2 project, bringing us from 7.5 to 15 million tons of high grade per year, one of the issues that we've had has been the rail. So our production has been working much better than the actual logistics side. We've since done quite a lot of improvements. Very unfortunate Q3 that we had that breakage, because it was going to be the first quarter that we actually surpassed the sales compared to the production. This is due to the fact that we've purchased new rail cars to be able to help on the whole logistics. The rail supplier has gotten new locomotives in, quite a lot of new people in that they trained to be able to operate the locos. So the whole circuit has been running much more smoothly. Still some improvements to make, but we thought we'd at least be able to match production and even surpass it a little bit. Hopefully, we'll be able to see this in the coming weeks, and when we meet again at the end of the next quarter. So hopefully we'll be able to show some positive results from all of those different elements. But 2025 should be the year that we're able to start bringing down tons from our stockpile, which should increase our cash flows, because we've got quite a lot of tons sitting at site right now. Roughly about 2.7 million tons at the end of last quarter were sitting at site. So that's a lot of cash that's sitting there ready to be able to enter the market. And we've also got some improvements that we are doing to be able to benefit from the increased production as well. So twofold, when you look at 2025, starting bringing down the stockpile to benefit from that cash, and also improved production to start debottlenecking our assets.
Okay, so operationally, there's a lot going on there in terms of that kind of feeding that into the market, driving revenue, increasing margin, etc. Again, if you can break it down for us, folks, to try and understand what's important to you to kind of drive that bottom line number. What do you need to get right? So
the rail is definitely one element that needs to go right, and that we're focusing a lot of the teams are focused to be able to do that. Second element is really to make sure that we've got the right partners going forward in terms of our clients. So we're currently working on a big CapEx project, which is to be able to increase the grade of our material to make one of the purest high-grade iron ores in the world. So we're investing roughly about 470 million Canadian to be able to make this new product. This will make half of our tons at 69%, which is pretty much the highest grade you can go, and be able to enter the new market to make greener steel. And this, big advantage for us, because when you look at our margins, it allows to sell to clients that are closer to home. So we're selling just over 50% of our tons into China right now. Once we deliver this project, half of our tons are going to be sold in Northern Europe, in Northern Africa and the Middle East. So you're looking at lower levels in terms of shipping price. And you're also looking at better margins because we've got this high purity material. So when you look at what we're doing right now to be able to drive the bottom line, it's really making sure we've got the right clients lined up, and that we're signing the right contracts to be able to get this new product to the market, which will deliver higher margins for our shareholders.
And obviously, you've been quite sensitive to the kind of, China geopolitical tensions, right? And obviously 50% of your product going to any one customer is probably never wise on the whole, because you set yourself up maybe open for some future event which you can't foretell. So these additional markets, whether it be Europe, North Africa, etc., are these higher margin, not just because the product's higher purity, but in terms of, do they pay more than China does? Have you ever had problems selling into China?
Yeah, we've never had problems selling into China. And even if just over 50% of our tons go to China right now, we're actually one of the least exposed to China in terms of iron ore producers. So the other larger iron ore producers are much more involved into China. So we're already not that exposed when you look at the rest of the world. But realistically, when you look at geography, we can't move the tectonic plate, so we can't get closer to China. And that's our most expensive route to be able to sell tons today. So what we want to make sure is to be able to sell those tons into Europe, Middle East, North Africa. So when we talk about higher margins, one portion goes through lower shipping costs. So that's one of the elements that we can benefit in terms of higher margins. Second, the rest of the world typically pays on the index that is set in China. So we're getting probably the same prices as we were if we're selling to China when we sell to these different clients. Where we've got a real differentiator is with this new product. There's no official index today for the new product that we're going to make. So in today's world, there's the index for the 62%, which is pretty much the bulk of the iron ore being sold in the world. There's a high grade index that is the 65%, but tomorrow's high grade is not the same as today's high grade. So we're getting into this new market, 69%, a more captive market because they need this material. They can't play on their productivity to be able to accommodate lower grade and some higher grade and play the market. Once you're committed to go towards that DR route, direct reduction and electric arc furnaces, you're much more captive in the quality of the material that you want. And what we're looking to do now is to be able to sell more towards that DR market, which trades closer to scrap prices. So we're getting more linked towards high grade scrap, towards steel prices, and a little bit less towards the iron ore. So that's a real differentiator to benefit from higher margins in the future.
Okay, so this kind of upgrade to 69% on, I think, Bloom Lake, you're fixing that on, is that right?
Correct.
Right, okay, and then the DR, the pelletization route as well. That's kind of earlier, so you're still assessing, how that works really. So when does that start to kind of kick in and have an effect on the bottom line for you?
So that's why 2025 is such an interesting year for us, because we started many years ago working on this project, sanctioned it last year, and it will be delivered in December of this year. So December 2025, we're going to have our plant up and running. It's going to take a few months for us to debottleneck it, ramp it up. But then starting early 2026, we're going to start selling into this new market. So half of our tons, 7.5 million tons, will be at 69%, and we'll be able to sell at these different pricing formulas.
Right, and how much have you spent on both of those, the sort of upgrading to the 69% and the DR palletization? I mean, so what's basically, I'm trying to understand what's going to return on that capital invested going to look like for you.
Yeah, so when we look at that market, basically we invested around 470 million Canadian to be able to get there. Now we've spent about 60% of that capex, finalizing the spend this year. So once that is completed, well then our operating cost difference to make this material is fairly low. We have about $7 US per ton in our feasibility study. And we're pretty confident in that number once we start operating the project. It's a fairly easy plant. Once the capex is spent, fairly easy plant to operate. Known technology in North America, so others have used it in the Great Lakes. So we don't see a lot of risk in terms of the actual operation. So we've invested the capex, about $7 increased cost to produce. But when you look at the premium for this material, just in terms of shipping costs, if we sell into Europe or into Northern Africa, we can save between $5 and $10 per ton on the actual shipping. So just the shipping beneficial almost pays for the actual operating cost. And then you've got the increased margin for this material. Right now in today's market, we probably get between $15, $18 per ton premium on top of that, and looking to be able to improve that over the next years. But you can see on 7.5 million tons, there's some pretty interesting premiums that we could be able to get. And this is in today's market, where it seems that decarbonization has taken a little bit of a slower pace, but I don't think that's going to last. As we mentioned, quite a lot of plants and steel is transitioning towards greener steel. If there's even more demand for this material, that premium can increase significantly in the future.
Okay, and obviously you got to get there. So in Q3, obviously will have affected things like liquidity, etc. How do you kind of manage these kind of growth projects without sort of need to go back to market and diluting shareholders? And in fact, in terms of that long-term debt management strategy that you're going to need to, come up with, what does that look like between now and the delivery of those events?
Yeah, in terms of raising equity, I'd say we're probably one of the least popular companies with the banks, because last time we raised some equity was because we had to start up the operations. But since we've been in operation, we've never raised any equity. It helps to have management and directors own close to 10% of the business, because we don't want to dilute ourselves either. So we're fully aligned with shareholders on that front. When we look at the growth, you're right to say it's been a pretty intensive CapEx run over the past years. So we've started up our phase one, so the actual operations. Then we had to deliver the expansion. Now we're doing this upgrading plant. So we've invested over $1.7 billion in CapEx in the past 6 years. 2026 is the first year that we've got basically no growth CapEx being invested. So we're really going to see the earning power and the right mix of redistribution of capital to our shareholders. So when you look at the 2018 to 2025, a lot of investments, and now next year we're going to start reaping the benefits from all those investments.
Right. Okay. So Q3 has affected a lot of things, going to skew the numbers, skew the trajectory, etc. Were there other things obviously in there in say over the last 2024 or the last 12 months, whatever numbers you've got in your head, that you think, well, they can be better, they can be optimized, and we will see sort of some quick returns to performance if we get those things right in the next quarter, rather than these sort of longer term projections that we're looking at?
Well, definitely the rail is the one element that is going to help. So when we look at the rail in 2018, 2019, no one ever spoke about it. We had a contract for 7.5 million tons, delivering 8, and there was never any issues to bring down the tons. We've had some hiccups now since we've delivered our phase 2. The first time this rail is delivering as many tons, and there's been a bit of a challenge in terms of the ramp up. But realistically, when you look at the capacity of that rail, it's got a capacity more than double what is being utilized right now. So the only issue is the amount of rail cars, the amount of locomotives, and the people that drive those locomotives. And unfortunately, these people take time to train. So that's why we saw hiccups in 2022, 2023, 2024, but starting to get better over the past months. And 2025 short term should start being very positive, because those locos are in, the rail cars are in, and the people are in as well.
Right. Okay. So you're saying that's the number one thing that people should be looking at. You've been stocking up, and it's ready to go once that rail line is in. Number one return for 2025 is going to come from that.
Yeah, and as soon as that happens, you can imagine we've been discussing a debottlenecking project for the past, let's say, year and a half. But realistically, once the rails start delivering, then it makes sense to start maximizing the tons in terms of production. Right now, every extra ton that we've done in early 2024, we had to stockpile. So not the best business proposition to be able to start working full on a debottlenecking project. But when you look at 2025, as soon as that rail is able to hit production and even more, well, then there's a double potential increase in terms of margins and in terms of benefits for shareholders, because we'll be able to bring down tons from our stockpile, but also potentially maximize the amount of tons that are being produced. So a few key elements coming short term, as you mentioned.
Okay. And if I look over to Cami, does the recent events and the volume of the deliverables that for 2025, does that slow down anything with the Cami feasibility study? And what role do you think it plays, and over what time? Where do we start loading up value onto Cami?
Cami is a very interesting project when we look at the type of material and the way that it fits into Canada. Because when you look at about a year ago, we delivered a pre-feasibility study on Cami. It had a pretty low IRR when you looked at the price environment. And we got a few phone calls from different people asking what's going on with this. But you saw in December, you have companies like Nippon Steel, fourth largest steel maker in the world, and Sojitz that came in at a valuation that was exactly pretty much the NPV of our pre-feasibility study, bought 49% of the project, and they did a subsequent press conference in Japan saying that they toured the world, and this was the best high-grade project that they were able to find, and they wanted to align with us because of our construction capability and operations capability. So we were able to do this, and the way that we structured the deal, it basically means that the first $500 million of investment will be done by the partners. So there's no champion shareholder money that has to be invested over the next years on Cami. So I'd say that the feasibility study doesn't slow down the permitting either, and this puts us in a sort of 2-year time frame to deliver that feasibility study and also deliver the permitting. Once that's done, well, then definitely we'll sit down with our partners and be able to evaluate what's the right timing to be able to bring Cami in. But I think the interesting thing is great potential for our shareholders, limited exposure in terms of what we need to invest over the next years, and a great option for the future in terms of high-grade iron ore.
Right, okay. And with regards to kind of the balance sheet at the moment, what's that look like in terms of cash at hand? How quickly you're burning through that? Is there debt on the books at the moment?
Yeah, so there's debt right now. When you look at the past years, we were always pretty much in net cash position. Now we're investing quite a lot to be able to finalize this DR project, or the flotation project that we're working on. So a slight net debt position. But again, next year is really going to be the year once we start all the investments, or the high ticket investments have been completed, start generating quite a lot of cash. And the other sort of outlier is the fact that we've got $200 to $300 million sitting at site in terms of inventory. But it's not because the market can't take the tons. The market would gladly take them. It's because we need to just bring them down. If we brought down those tons today, we'd be in a net cash position again. So.
Okay, now how do you view debt on the balance sheet going forward? I'm just going to get a sense of how you think about these things. Obviously, you talk about Nippon Steel and Sojitz putting in the first $500 million on Cami, but you've got your own kind of OPEX projects, or CapEx projects, and OPEX coming down the line to manage. So debt, you comfortable with that sitting on the balance sheet for a period of time, or do you look to pay that off quickly?
We've never liked to have a lot of debt. As a company that works in commodities, I think it makes sense to have a very conservative balance sheet. The last thing that we want to do is to overexpose our company. And as we mentioned, we own 10% of the business as well. So the last thing we want is to put that company at risk, because it's really our company. It's not just us playing with other people's money. So we're fully invested, and we want to protect what we have now. So to have a portion of debt makes sense to allow us to do certain projects. Sometimes there's timing, like right now in terms of our flotation plant, need to invest, and we get the benefits only starting next year. But the last thing that we want to do is to over leverage the company.
Yeah. Right. Okay. And I guess just finishing off, like I think I alluded to at the beginning, the the sector, the industry has done a really good job of kicking itself in the shins. People blowing up around, build outs, even economic studies, getting it horribly wrong, and delays. And I think the retail side of things very wary about the industry's ability to actually manage money and spend money efficiently. How do you view the market from that regard, in terms of that kind of caution that's here, your ability to access capital when you need it, and I guess more importantly, your ability to kind of steer and navigate your way through all of that?
Yeah, when we look at Champion, I mean, that's one of the reasons why I've only invested in Champion. I haven't invested in other companies myself, because I trust in what we do. And we deliver the right studies, we deliver real numbers to the market, and that's why we've been able to hit 3 times projects on time and on budget. And we strongly feel that it makes sense to bring the real numbers to the market. What was maybe a little less popular when we got our Cami study out, when you look at the pricing environment that we delivered it in. But if we say it's going to cost this amount, this is the amount it's going to cost. And we had some investors call us and say, "Are you going to optimize your feasibility study?" And we said, well, we delivered a great feasibility study. It's just might not be the right timing now to be able to do it. But the last thing we want to do is pretend that it's going to cost less and then have cost overruns. So that's not the business we're in. We like to bring the real numbers to the market. And as I mentioned, we deliver projects on time, on budget. So I appreciate the sometimes skepticism in the market in terms of when they look at growth within mining companies, but we've been very diligent in the way that we approach our projects, and will continue to do so in the future.
Okay, so you sound positive. You sound excited about 2025 and 2026. So just to remind you, just finish off, if you don't remind us what those the key deliverables are that people should be looking for, and maybe a sense of the timing of each of those, if you don't mind.
Yeah, I'm very excited for the next 2 years. When you look at 2025, should be the first year that we're able to sell more tons than we produce. So a lot of these hiccups that you've seen in the last quarters should be something of the past. So that's going to be extremely positive. Bringing down more tons also will allow us to reduce our operating cost per ton produced, increase the margins that we're delivering. So quite a lot of elements that are interesting. So short term, a lot of positives for our company. Medium term, well, we're getting out of a very large CapEx cycle. So since 2018, we've been investing heavily in our operations, invested about 1.7 billion to expand the project, to make a different kind of product that we're delivering this year. And then 2026, first year since we started, that we don't have a large CapEx program, that will be able to fully benefit from the investments of the past. So short term, debottlenecking our operations and making them better, reducing our operating costs per ton. And then 2026, really demonstrate the earning power of our company without all the CapEx programs of the past.
David, appreciate your time today. Thank you very much.
Thank you, Matt.